Here is a question that should stop any currency trader in their tracks. What happens when a country releases strong economic data, and its currency still falls against the US dollar? That is exactly what Britain is facing today, Sunday the 26th of July, 2026. The British pound is struggling to hold its ground against the greenback, despite a string of robust UK economic figures that, by any conventional logic, should have given sterling a meaningful lift. Scotiabank, one of Canada's biggest and most respected financial institutions, put it plainly in their analysis published this Friday the 24th of July, strong UK data has simply failed to lift GBP against the dollar. So why is that? And what does it mean for anyone holding pounds, trading Forex, or watching international markets right now? Stay with us, because this one matters considerably more than the headline figures suggest. Let us be clear about what we are dealing with here. The UK economic data that emerged this week was, by most measures, genuinely positive. Britain's fundamentals are holding up better than many analysts had predicted given the global backdrop of persistent uncertainty. These are not soft indicators or sentiment surveys either. We are talking about hard numbers that would ordinarily be expected to signal confidence in the pound. In a normal cycle, when a country's economy performs above expectations, institutional investors tend to pour capital into that currency, pushing its value meaningfully higher. That is the standard playbook. What we saw this week included indicators pointing to resilience in the UK labour market and domestic spending patterns that exceeded forecasts. In any other environment, these prints would have traders piling into sterling, pushing pound sterling to US dollar noticeably higher against all comers. The fact that they have not done so tells you everything about the external forces bearing down on the pound right now. Scotiabank's currency strategists have been clear in their assessment. The problem for the pound is not a lack of good news on home soil. It is the persistent strength of the US dollar, which continues to act as a ceiling on GBP gains. Even when sterling has a legitimate reason to rise, the dollar's weight is simply too much to push against right now. This creates a deeply frustrating dynamic for pound bulls. You have a situation where the UK economy is doing its part, producing the kind of data that should attract buyers to sterling. Yet pound sterling to US dollar is still struggling to find decisive upward momentum. Scotiabank's view, published on Friday the 24th of July, confirms this tension is not a short-term blip. It reflects a broader structural imbalance in global currency flows that is favoring the dollar in the current environment, regardless of what the UK data says. So why is the dollar still so resilient? Part of the answer lies in what is coming up this week. The U.S. Federal Open Market Committee, the FOMC, is set to meet, and that meeting is casting a long shadow over all major currency pairs, including pound sterling to US dollar. Scotiabank's own dollar analysis, also published on Friday the 24th of July, noted that softer U.S. Treasury yields are currently curbing further dollar gains ahead of that meeting. In other words, the dollar is not surging outright at this moment, but it is firmly refusing to give meaningful ground either. Think of it as the dollar sitting in a defensive crouch, waiting for the Fed to show its hand. Until the FOMC delivers a clear signal on the path of U.S. interest rates, traders are maintaining cautious positions, and that caution is keeping the pound pinned below the levels the UK data would otherwise fully justify. There is another layer to this story that goes well beyond the immediate data releases. Bank of New York Mellon, known as BNY, raised a pointed and serious concern just last week, on Tuesday the 21st of July. Their analysis warned that what they described as a fiscal shield is testing both gilt credibility and FX credibility for the British pound. Gilts, for those who are not familiar with the term, are UK government bonds, and their credibility is deeply tied to the pound's perceived value on international markets. If investors begin to doubt the UK government's long-term fiscal discipline, they will demand higher yields on gilts, and that pressure can weigh on sterling even when short-term economic data looks healthy and positive. This is a structural risk rather than an immediate crisis, but it is a genuine cloud hanging over the pound. It is precisely why GBP is not getting the full benefit of those positive weekly data prints. If you are a UK resident who holds foreign currency, travels abroad regularly, or runs a business that imports goods, this pound sterling to US dollar weakness has a real and tangible cost. Every time you exchange pounds into dollars at current rates, you are getting less purchasing power than you would if sterling were trading at its fair value relative to the UK's economic performance. For businesses that invoice in dollars or carry dollar-denominated debt, the situation is equally uncomfortable. Import costs remain elevated when sterling is soft, and those costs filter through to consumers over time. For savers and pension fund investors with international exposure, pound weakness also quietly erodes the sterling value of any foreign assets you hold. It is a silent drag that adds up over weeks and months. For active traders watching pound sterling to US dollar on the charts today, Sunday the 26th of July, the dominant question is whether this week's FOMC meeting will finally shift the balance in sterling's favor. Looking at the near-term picture, the outlook for the pound remains cautious at best. The FOMC meeting is the dominant event risk this week, and it carries the potential to move pound sterling to US dollar sharply in either direction. If the Fed signals that US rate cuts are still some way off, dollar strength is likely to persist, and pound sterling to US dollar may struggle to break through key resistance levels despite further positive UK data. On the other hand, any sign that the Fed is moving towards a more accommodative stance could trigger a sharp short-covering rally in sterling, given how many traders are currently positioned cautiously against the pound. BNY's fiscal concerns and Scotiabank's structural analysis both point to the same conclusion: the pound needs more than just decent data to sustain a meaningful recovery. It needs a clear catalyst, either from the Fed or from UK government action on fiscal credibility, to genuinely regain upward momentum against the dollar. So here is the bottom line as of today, Sunday the 26th of July, 2026. The British pound is caught in a difficult and telling trap. UK economic data is performing well enough to justify a stronger sterling, but the combination of FOMC uncertainty, persistent dollar resilience, and BNY's fiscal credibility warning is keeping a firm lid on pound sterling to US dollar. Scotiabank's verdict is unambiguous: good data alone is simply not enough in the current environment. The pound needs the broader macro picture to shift in its favor. This week's Federal Reserve decision will be the single most important test for sterling in the near term. Watch pound sterling to US dollar closely on Wednesday when the FOMC statement lands, because that one event could define the pound's direction for the next several weeks. If you found this breakdown useful, give it a like, share it with anyone who follows the currency markets, and subscribe so you are ready for our full FOMC reaction the moment it drops.